This is Network 18. And you are watching CNBC-TV18.
Every quarter. But let's get back to the macro. Subir Gokarn of Brookings is with us now. Subir, good morning and good to see you again. We've been talking to several...
Thank you then. Good to be here.
Thanks. Several economists who have been saying for the last 4 or 5 months that the economy has bottomed or is bottoming. But when you look at the monthly numbers, the PMIs, the IIPs, are you getting the sense that even a modest upturn has started, or this is a very protracted kind of bottom that we are bouncing around in?
Well, I'm not even sure we're bouncing actually, because it does look like we have hit a bottom looking at the sort of high frequency numbers, but I don't see any significant indications that there is a recovery. And I particularly want to emphasize the last two IIP readings, where the big driver of the 2%, 2.5%, well, March I think has come out at 3, a little over 3, are garments. 150% growth in garments in March, 87% growth in garments in April. And what's supporting that is 2.9% growth in textiles and 5% in March and April. So there is a little bit of an inconsistency that I see there in terms of these numbers, and that's always been the case with the IIP. You're seeing some outliers on the positive side and occasionally outliers on the negative side. But if you take those high numbers out of the picture, it doesn't look like there's any particular momentum, and I think this is borne out by supporting evidence from the big industries which put out monthly numbers independently. Auto is clearly a case in point. So bottom perhaps, recovery, I'm not sure that we're seeing any signs of that yet.
The other thing which everybody was beginning to get a bit hopeful about was our current account deficit. But there too, the recent price of commodities, the way the rupee has moved, and also this food ordinance bill, which will become a reality soon, are making people a bit apprehensive that maybe it's too early to start celebrating on that front. What's your assessment?
Well, I think the current account situation is the outcome of a number of different factors, and each one really needs to be addressed with a specific response. We have the oil problem. Clearly, that was on its way to being addressed to some degree by virtue of the diesel price corrections, which are still happening. But in a sense, they're happening at a rate which makes them vulnerable to both oil price movements and currency movements. So the gap just keeps widening, and that clearly creates some problems. On the gold side, we've seen a number of responses in terms of, as your earlier guest said, both customs duties and liquidity controls or some sort of import restrictions, the ability to import before sort of committing and so on. But I think these are really band-aid. You have to do something to have a quick impact, but the long-term, medium to long-term issue here is finding ways in which people can invest in either alternatives to gold or invest in gold without requiring physical import, which essentially means designing financial products that allow people to invest in gold derivatives essentially, without requiring 100% physical import, which is the situation now. Even the ETFs are required to hold 100% physical backup before they can issue units. So you've got to break the link between investment and import. I think that's the fundamental requirement, and what we're doing now really doesn't address that. And then we've got the minerals issue, which is virtually sort of stoppage in exports of iron ore and huge increase in imports of coal. That's the basic sort of equation that we're seeing now, both of which are clearly putting pressure on the trade account. So a number of things are contributing to this, and they need to be addressed. And I don't think we can look at a credible sort of resolution of the current account pressure unless we move systematically on all these fronts.
Subir, good morning. Good to see you in after a long time. As you know, the sore point this morning and for many days running has been what's happened with the currency. Admittedly, it's an emerging market problem, but what have you made of the tailspin that the currency seems to be getting into, exaggerated, of course, because of these current account deficit concerns, and what it might be pointing to for us?
Well, I think the scenario that we have today is somewhat similar to the scenario that we had in 2011 and then again in 2012. But the situation perhaps a little more fragile because the deficit is so much larger today. The shock was common to emerging markets. The shock was triggered, as we all know now, by the expectations that the Fed would roll back on its QE3 commitments. And that would have, I think, logically resulted in revaluation of all currencies vis-a-vis the dollar. That's what's happened. But the impact of the shock on different countries has been different, and that is clearly related to the size of the current account deficit and the prospects for its turning around. So as we look ahead to what the currency might do over the next few weeks or few months, I think the bottom line there is whether we are seeing adequate corrective responses, adjustments in the current account, either through spontaneous adjustments or through policy responses.
That's exactly what I was coming to, Subir. I remember talking to you at that point when you were Deputy Governor of the Reserve Bank, and you pointed out that volatility was a necessary extension of a market, and not necessarily in two ways. Volatility could happen in one direction as well. What kind of steps do you think either the Reserve Bank or the government should be taking? Because they've done some stuff, at least in terms of addressing gold imports, but it really hasn't helped.
Well, I think there is you need a sort of a plan or a strategy that involves both immediate actions and credible medium-term commitments. The immediate actions, we've seen them roll out in the last few days. We've seen the gold issues being addressed through customs duties and the other restrictions. I believe we've seen some action on the flexibility on cancellation rebooking being brought in again, which is something that was used in 2011. So these are all short-term measures that try and contain the risk of sort of spiraling out of control. Also issues relating to increasing capital inflows, so easing some of the restrictions on debt. That's been happening for a while, and I think you don't have a lot of room there, particularly in a scenario where the exchange rate expectations are so negative. People's willingness to invest in rupee denominated debt is going to obviously be impacted by that. How do we get FDI back in action? How do we get people to start investing again? That's very much part of the strategy, although it's not directly related to managing the balance of payments. Creating sort of long-term comfort on investment flows is critical. So there is clearly a short-term component which is being tried out and will have some impact. But there has to be also, I think, much more explicit and much more detailed medium to long-term statements which are backed up by action. I think that's where the risks run quite high, because we have a lot of statements, but people are beginning to sort of be a little skeptical, and have been for a while, about these statements being backed up by concrete actions.
Which part of it would you focus on, Subir? Because going by what the government has been saying for the last many months, it seems that they're trying to do a lot in terms of financing the current account deficit, in terms of the finance minister making repeated road shows, allowing windows for FI flows into debt, etc., but not quite addressing the core issue of what would lead those flows into India and addressing the current account deficit problem by itself. Do you think on that we are falling a bit short over the last few months and we are barking up the wrong tree?
Yeah, it goes back to the three drivers of the current account deficit that I mentioned. We perhaps need to move a little faster on oil, but of course that is also in terms of disrupting whatever little growth so stability we've achieved. But I think on the gold front and on the minerals front, there needs to be much more aggressive action. There is a report that the RBI put out a few months ago suggesting financial innovations to address the gold problem. We've had one move there on the inflation-linked bonds, which I think are inflation index bonds, which I think is a very good step, because that's one alternative, one clear, credible alternative to people investing in gold. We have to penetrate. That has to penetrate, but at least it's a start. So on the financial side, I think it's very important to get these gold substitutes in action, and you need to move very quickly on that. And on the mineral side, that's another area where we've got to start moving. So obviously you don't expect the coal problem to be solved overnight, or the iron ore environmental concerns to be addressed overnight, but we're one step short of even having a sort of action plan with some credible time commitments. I think that's something that needs to be articulated very quickly. How are we going to address the coal shortage? A few days ago we had the chairman of Coal India saying that a 35 million ton import requirement has now been scaled down to 5 million based on lower demand. But that doesn't square with the kind of capacity we've created in the power sector. The number of megawatts we've added in coal-fired power plants. If you want to keep those active, then it doesn't appear that you can do that without substantial imports of coal. So that's, I think, a huge priority, a huge challenge at this point. And it directly addresses the issue of both balance of payments and investor confidence. It does have a powerful, or it's either dragging very heavily, and or if it's solved, would provide a powerful boost.
You spoke about the fact that there is no major recovery sign visible, but government spokespeople still continue to speak about a rebound to 6% growth miraculously and 7% next year. Do you think it will happen automatically, or there is a real threat to those kind of targets being met?
I think if we had not seen this rupee instability in the last few weeks, there was some prospect of the 5.5 plus kind of range being achieved. The Reserve Bank had forecast projected 5.7. There were a number of private forecasters in the 5.5 to 6 range. So I think there was a broad-based expectation that two basic drivers would come back into play. One is inventory replenishment, which when we look back over the last year, clearly inventories had been scaled down, pared down, and interest rates going down would help to drive that. And sort of what typically is called debottlenecking investment, which is not large projects, but just streamlining and aligning existing capacities, so you're getting a little more out of them, and little money being spent on investment there. With the kind of new instability, perhaps those are also at some risk. I'm not in the forecasting or projecting business right now, so I will not make any comments on whether it's possible or not. But I think we have to watch out for how corporates are responding to the currency instability right now, because I think it will feed back into these two drivers as well.
Is it just the currency that's changed equations though, Subir? I don't know if you heard us speaking with the management from Ashok Leyland a short while back. Trends for some of these sectors have been extremely poor through the course of this year, whether it's autos or cement companies. Infrastructure, as you pointed out as well, has been struggling. And now we are even speaking with corporates and understanding that consumer sentiment or consumer demand has started slipping. I mean, which leg do you think is going to lead the market towards this 6% recovery? Where is it that is going to show up first?
Well, I'm not claiming that there is going to be a 6% recovery. I said the forecasts that were made 2-3 months ago did not factor this kind of currency dynamic, factor into themselves this currency dynamic. And at that point, these two drivers of investment, I thought, were looking reasonably credible. Now things have changed, and I presume that people will start revising their forecasts. We'll have the first quarter monetary policy coming out end of July, so there will perhaps be a revised forecast then. But between now and the end of July, I'm sure a lot of people will factor in what's happened over the last few weeks and start to work their numbers down. And that, I think, will give us a better sense of what kind of impact we should expect to see from just this one factor. Of course, everything spirals, so if you do have a strong reaction, a strong positive set of actions, at least credible statements, on pointed actions that are intended to be taken, that can turn sentiment around. So I don't think the sentiment argument is that compelling at this point. But if it's left unchecked, and if sort of things don't fall into place in terms of a kind of a coherent and a coordinated response, that sentiment factor could obviously also add to the negative pressure.
A pleasure speaking with you, Subir. Thanks very much for joining in with your thoughts today.
This is Network 18. And you are watching CNBC-TV18.